Hi, this is Randy Finney with Right Side of the Chart, and this is an early session or really midday session update for Monday, June 9th, 2025. It is 11:58 a.m. Eastern Time, so almost noon today, about mid-session. And I want to just go over, start out with a very brief overview of the equity markets. We're not going to get too granular. We're going to look at the some of my longer term indicators. We'll start out with the monthly charts and look at the weekly charts of the major indexes. Then I definitely want to do an update on, it'll be obviously somewhat related, the semiconductors, and we're not going to do a deep dive. We're going to look at literally two semiconductor stocks, the two biggest ones, and the index itself. And then we'll go to Treasury bonds, very much related, and then financials. Time permitting, I'll hit on Bitcoin and gold, kind of the risk off. Well, depends on what time frame lately. Last couple of years, they've either been risk on or risk off assets. But let's stick with the equity markets and the things that I think are most closely related and worth watching right now. So the key is here, I'm going to start out with monthly charts and look at the long-term trend indicators and things to watch for there. Remember, today is June 9th, so we've got plenty of real estate between today and the end of the month. All that matters, the only thing that matters on monthly charts is how you close the monthly candlestick. Same thing in the weekly chart. So when I go through that, keep that in mind. I'm going to show some indicators based on the monthly time frame, some indicators based on the weekly, and things to watch. So we're going to start out here with WTI, which is the Vanguard Total Stock Market ETF. I cover this one quite a bit. It's the single best. If there's an ETF out there, there is none better than to kind of give you an idea what the U.S. stock market's doing. That's what VTI does. It covers the whole universe of stocks, attempts to track them all, mega caps, large caps, mid caps, small caps, micro caps. And so there's not, again, a single better. S&P 500's, we covered a lot. It's more of a tradable index. You have the futures there. That's why I cover that more often. And the NASDAQ 100, but the NASDAQ 100, all those two, SPY or the S&P 500 and NASDAQ, will follow this. You're going to have a higher beta with the NASDAQ 100, meaning it'll go up more in a bull market and typically and down more in a bear market. That's or corrections. And so VTI, you can see here, I have a couple trend lines. That's the, again, monthly chart. This is biggest picture there is, at least that I go to. I don't really, sometimes you can look at yearlies. There was an uptrend line back, defined the last real bull market, up to the late October 2007 highs, followed by the last true bear market. Is, again, you can define it however you want. There's been plenty other that met the technical definition, including COVID and the 2022 bear. But that one ran its course like a natural market with 5-wave, perfect Elliott wave, 5-wave count and all that good stuff. And on that, my trend indicators, there's several, but one that I like to use is the PPO. When it's we had a bearish PPO crossover, that's the PPO right here. So when the PPO line's below the signal line, you're in a bearish trend. It's not measured here, but that was about a 56% drop in both the NASDAQ 100 and S&P 500 and VTI. Probably dropped about that much then. And you can see, so basically you can see all the corrections. I don't have them annotated here drop-wise, but you can see without a doubt, you can just eyeball this chart and see every single one of the big bear markets and corrections as far back as you want to go were defined by the PPO crossing over. And what I'll note is, and I have noted before, typically you're in a larger secular bull market, so your best signals come on the sell signals when that flips from bullish to bearish, when you get these big green hills and then you roll over and you get the bearish crossover. That gets you in closer to the top than getting out at the bottom, because you're in a secular bull market. It tends once that flips. So we have a lot of other things we use there, such as uptrend lines or horizontal support levels, divergences, overbought conditions to get in quicker. But that just helps to confirm the trend once it has begun, just like it did back here. And when it flips, it's safe to say that the trend, in another case, the bear market, has run its course, or the correction. COVID right there. COVID was brief. If you blinked, you missed it, but it was there, and it was 36% drop in the S&P 500. And so I just wanted to reiterate again, as I have recently, we're still on that sell signal, that one trend indicator. It's not a be all. There is not a single be all end all indicator out there, but it does a pretty damn good job. The other one is, and again, if you followed me for a while, you've heard me use these. They're very simple and effective. This is the 20-month exponential moving average, again, on a monthly chart. And I'm talking about the blue dashed line here, right there. And again, if you look closely, and I encourage you to replicate this on your chart, use log scaling, put the 20-month, make sure it's set to exponential, and then look at the candle. You want to see where the candle closes. So it's not unusual to get an intra-month drop below. All that matters is how you close a month there. So COVID, it was real. You had that 36% drop. That was the candle there. The following month, you close right back on the line there, and then boom. So again, it's done a great job defining bear markets, and the big corrections as well. And that's it. So that one's on a sell signal. And the posture of the indicators, I take everything, collectively. That's just one of many things here. Let me move that over a bit. Click on that. This is the biggest and really only on that I can see here. I don't have it marked up. Yeah, there was a little bit of a divergent high right there. You don't get the divergent highs very often on the monthly chart. You did actually before COVID. I've mentioned that many times. COVID, we were short going into the COVID highs because of the same thing. The chart said there was going to be a correction or a bear market. And so say what you want about it. 99.9% of people will say it was just a black swan, random, unpredictable event. And that part of it was, but the charts and the technicals, as I often say, will almost always align, if you will. So you get a bullish setup. Bad news is bad news, good news is bad news, until finally you get the trigger, the technical trigger, and then all of a sudden good news is taken for what it is, good news, and bad news is shrugged, or ignored. Just like the inverse holds true in a bull market. So that's it. So in trend indicators, just wanted to point out the bearish PPO crossover still intact. Sometimes you do get a little, and it's not to say as if it didn't work. We had the biggest drop right there in years since the 2022 correction. We gained it. We're short at the top, covered lows. It's bouncing so far, and the $1 million question, which we'll know sooner than later, might take a few more months, is that it? Are we going to make a bullish crossover? As of now, that is not the case. So that trend indicator is bullish. However, we're also, on a sell signal, bearish. This one, we're back up. Actually, we never got the 20-month sell signal. So there's a great example of a big intra-month drop down below the 20-month right here. This whole part of that candlestick, and you didn't even have to squint to see if you got a closing monthly close. It wasn't even close. It closed solidly back above it. So it kept the buy signal in place. It happened back here when we took back the 20 months after being in a bear market. That was only simply a successful back test of it, a pull back to buy it, followed by a big explosive rally off it. And that's it. So I'll be watching that going forward. So like I said, I've been saying this. It's a mixed bag of technicals. The other thing you see here are two parallel uptrend lines. Obviously, the lower one, for the reasons you can see there, couple spike lows, both COVID and the end of the 2007 to 2009 bear market right there. But this is the primary uptrend line right here. It has more reactions. So that's what I call the BOD or secondary. Either way, they're both valid. And you can see this trend line here. You look at the pop-up box. I created that back in 2023. I haven't adjusted it, moved it. And it's not mere coincidence. That's where we hit. That's why we were covering shorts there. One of many, many reasons. You hit both uptrend line and price support. That was the previous all-time high in VTI, breakout backtest, and simply another backtest. So this is that's a massively big level, and we got work to do to get there. As I've been stating repeatedly, for long term, this is a monthly chart. This speaks to the long-term trend trader, investor, a longer-term swing trader. Until and unless we drop back down below the 200-day moving averages on the daily chart, I can't make a case to go to a full short or aggressively short long-term swing position. So that's that. Those are the levels to watch. But just a handful right there. Price, uptrend line, price support, 20-month EMA, and the PPO, again, on the monthly. We step down to the weekly. I'll do this a little faster. There's your same uptrend line. Again, we hit it to the button right there. You can see that trend line created back in 2023. Bounced as expected off it. It's been a pretty impulsive bounce, but That's all it is so far. Again, we didn't take out some of the longer term levels that we needed to. In other words, we bounced where we expected. Is that going to be a buying up like it was back here on the trend line, or right here, or right here, or is this just one last hurrah off the trend line? Again, it's the posture of the indicators plus the economic data that I factor in that tells me that's most likely the last hurrah off that trend line. Again, it was a bounce that was expected. It's carried a little bit higher than I expected so far based on my scale back in zone on QQQ and SPY, but it's still very, very much within the realm of what you'd see after a breakdown of a wedge like that, a big divergent high. And again, time will tell. So let's go to SPY QQQ. We'll do it a little faster here. Same thing, monthly chart. You can see right here we have SPY. If you look down below, you can see, and I missed this on VTI. I'm going to cover it on QQQ because I have the boxes done. The zero line right here, and that is what the histogram will show. That's what I was showing you. When you're below the zero line on the I'm sorry, that's the RSI. Take that back. I have it marked up for the PPO. The RSI will also give you that as well. The RSI typically the 50 level, the midpoint, defines bull and bear trends when you're above and below. And there was last bear market. What I'm showing you here is the same thing as a VTI. These are your what I call red inverted hills when the PPO histogram is negative, when it crosses down below. And without exception, all of the bear markets and all of the big corrections, profitable ones to trade or to get out of your longs in recent history, we're talking decades, have clearly been coincided with these flips of these hills. So you got 57%, 22, 15, 20, 36, 27. I didn't measure it here, whatever it is. And that one's still red as well. You can see all the red bars. And the big divergent high as well, which, we had sell signal there. We hit that blue uptrend line. Again, bounced as expected, successfully kept above the 20-month on a monthly basis right there. So those are the things I'm looking for on the monthly chart. Again, anything that happens between today and the end of this month, I'm going to say it doesn't matter. If you get way down below there, and especially if you get towards, the final week of the month, final few days, and it looks like it's almost impossible, would almost be impossible to get back above there, that you can say with a pretty high degree of confidence you're going to close below and trigger those long-term monthly sell signals. Again, we're on some of those, as I showed you the PPO histogram. Now I step down to a weekly chart on SPY, and I have this on QQQ as well. You can see without exception, here's the PPO. So again, this is what the histogram will show. That zero line is right there in purple. And so you can see these red boxes. Again, without exception, 57%, 22. We had a couple back-to-back. This was a sideways market for about a year and a half. It was close to, I think it was 15, maybe closer to 18 months. 15 and 15% double drops right there. More on the NASDAQ 100, more on the small caps. And again, without exception, 21%. I'm talking from the divergent high down to the lows. That's what these numbers measure, the divergent highs. And it's not mere coincidence. Again, let me repeat that. It's not mere coincidence. I've had these levels marked on this chart for a long time. Divergent highs going back, marking this chart up. And my point is, it's not mere coincidence. The divergent high precedes the trend change, right? It's the simple stuff. It's big picture stuff. I know a lot, and I say this because a lot of people are going to lose in faith in the charts or my analysis. Again, do your own thing. We have a lot of other trade ideas. We have longs, we have commodities, we have different asset classes, analysis on bonds. This is just one thing, but this is the stock market. So we kind of, put most of the focus there because it's showing you where the primary waves are going. So if you're going to short a certain sector, a certain stock, you want to make sure it has a very good chart, very good chance of playing out because you're going counter trend trades. And again, the most profitable trades in the world, if you go and Google it, the most successful traders in the world, the ones that have made the biggest profits. You go back, I think I've done this, some like 80% of them, the names, you get Jesse Livermore and, Burberry and all these guys that have shorted, the crash of 29, the bear market of 74, the dot-com bubble, the financial crisis. The vast majority of the biggest trades made were short side traders trading bear markets, but we're a very limited, Very, very few people short, and you gotta be on. Timing's got to be spot on. Most importantly, you can't be too late to the party. You can be a little late, especially if you're getting in the right trend. But getting out, and that's what work hard. You got to cover those shorts. You can't stay too late to the party because you have explosive bear market rallies, and even during corrections in a bull market, it's boom. So if you waited just, sometimes even a few days, certainly a few weeks too late, you've probably given back most, if not all, your profits, depending on where you got in. But again, guys, this is simple stuff. This is technical analysis. This is what we're doing here. We're looking at that. All these red boxes are when the PPO was below there. So you would have I don't have the histogram up on this weekly chart, but it would be red, and it still is red. We'll zoom in real tight. There's the there's the PPO line. Again, it's the signal line. I need to be clear on that. The 9 EMA on this indicator down here, not the histogram. The histogram will show crossovers. This one right here, I like to see that white line, again, the last of the two, when it's above or below, that's what delineates the bull and bear trends there. And last but not least, QQQ, and that's what it says. PPO line delineates bullish and bearish trends when the signal line, which is the 9 EMA, it's the white line, is above or below it, with the trend changes typically coming shortly after the bearish crossovers during the bull markets. That's what I talked about before. So we've been in, remember, one of the biggest in history, and it coincides, again, not with mere coincidence, the biggest secular bear market in interest rates, which by many metrics, as I've covered in the past, is most likely over. So I'm going to get to treasuries here shortly. Just want to say this is what I'm watching, and we zoom in real tight. You can see here, we're close. In the last week or so, I told you that the odds shot up above, I call it, coin toss odds, slightly favorable, that the market will punch out the new highs only because it's so close and it has a history. When it gets that close to previous highs, it usually pops, makes a marginal new high, and then corrects. Breakout right here, went sideways for a few months, corrects. So again, coin toss odds, maybe slightly favorable odds. We're going to go, and it would look, you can see that back test. Look at QQQ, has that beautiful uptrend line. It would just, technically, it would be a very nice, clean scenario to see a full back test. We haven't touched it yet. And that would make a marginal new high, still very much a divergent high. The divergence will only extend. But if we go up much more, we're going to flip the PPO signal line right there. Again, the white line. But as of now, we're just back testing. And what happens when you go back on a lot of securities, let's see if I have any example. There it is. There's a great one. Last real bear market. We had a nice, healthy bear market rally. It fell a little shy of the previous highs. Again, this was a 56% plus drop. Doesn't look like a lot because we're zooming out here, but that's what that was, the financial crisis, 07 to 08, 09. And you can see the PPO came up, made the white line. The blue line crossed. That's why I use the white line. It helps filter out whipsaws. It's the last of the two to cross. It's the 9 EMA of the PPO line. So it's going to follow it with a lag. And so there's a great example. And just like back then, I remembered, because I was trading, I was doing the same thing. The masses thought, oh, that was just a great correction, buying opportunity on the road to new highs. And again, I'm sticking to the technicals. So that's what I do here. I provide technical analysis. My view will change when the technicals change. Right now, again, we're above a lot of primary uptrend lines. We're above some of my longest term indicators are still on buy signals. Few of the intermediate to longer terms have rolled over, which I'm covering in this video. And that's it. Monthly chart. Again, one of the good ones here is the PPO histogram, and that has not crossed. And we've got a lot of time between now until the end of the month. So these are the things I'm watching. I will tell you this right now. I would suspect that whether or not we go on to make a marginal new high, if we do, it's probably going to be within the next week or so because the momentum's here. The momentum's been stalling out. That's what these things I use down here are called. These are momentum indicators: the PPO, the RSI, the MACD. There's other ones out there. You have also oscillators, stochastics, and other things like that. But the momentum indicators, the momentum is waning, and that's been evidenced when you look at right here. You go down to a daily chart, which I just did. This is the negative divergence. This is the big part. This is the first divergent high we've had in a while. It's a beautiful little wedge pattern right there. There's the current uptrend line. And that's it. So we can certainly wedge a little higher here. You just take the divergence line as long as that divergence remains intact. But what this divergence again shows us with these indicators right now, as they are making lower highs with prices making higher highs, it shows the momentum is waning. And that's what trend changes. That's how we recognize when a trend change is likely to occur. And then, as I always say, overbought, oversold, negative divergence, positive divergence, those are conditions. They are not buy and sell signals. They are merely conditions. Conditions which often precede trend changes. The trend changes come on buy and sell signals. Those can come in various forms. They can come in the form of a breakdown of a short-term uptrend line like they did back there. They can come in the break of below a trading range like they did right here as highlighted. They can come below the break of support levels like key moving averages as they did right there. Those are all sell signals. And then objective short entries, this isn't necessarily a sell signal, but it was an objective short entry as highlighted back then, a rally back to the 200-day moving averages once they're taken out. So now we need a sell signal, and first sell signal, another type of sell signal, of course, are candlestick, bullish and bearish buy signals and sell signals and reversal patterns, stuff like that. So we'll look for that, and that can come in one of many different forms, or we look for a solid break below the trend line right there. So, all right, I lied a little bit. I didn't get granular. I just showed you 3 different indexes, the big ones that matter, and the market will follow. This one's more for trading and more for a guy, idea where the stock market is. You look at SPY and VTI. All right, let's move forward here. We can go to a 60-minute chart if you want. Again, you can see that's the same wedge I had on the daily. It's just this, if you want to zoom in on it and kind of get a look at that. We're just dancing on this, the same uptrend line I've been giving you here. We're just wedging higher. Any little pop up there will still be divergent high. However, as I've addressed before, the NASDAQ and any index, sometimes they do pop, make that marginal new high, and then fail. Other times, like back in 2020, late 2021, early 2022, it looked like it. The S&P 500 punched right through, made a slight marginal new high in the beginning of 2022, but the NASDAQ 100 failed to come above its previous high, and you got all this that followed. So that could certainly happen here, and that's why I keep saying the word coin toss odds, guys. I can tell you that's my view I feel pretty strong on. All I can tell you is when the odds are going to increase. And again, this is two-pronged right now. We have both a short-term swing trade idea. Again, since I added these targets here, T3 and T4, that extended a stop. That initial stop was for someone that shorted right here when we first shorted. Then we covered there, or could have covered there. That was the first target. It could have re-entered. So kind of that stop is all dependent on if and when you're even shorting this thing or going to short it. And these targets I still maintain. And again, if we get to T4, it's going to have changed the technicals on the more significant daily chart. It might not look like a lot here. It would be a drop of about 12%. But on the daily chart, what it would do if, again, T4 is hit, that 12% is going to take us back down below the daily, the 200-day moving averages on the daily chart, and therefore sharply increase the odds of my longer-term targets being hit. All right, we're going to move over on changing gears on a very closely related note to the NASDAQ 100 is this SOXX semiconductor ETF. It's the ETF that tracks the SOXX semiconductor sector. Back here, I gave you this yellow box, which is a shorting zone. Anything above it's a no-go zone. So as of today, technically no-go because, well, you got to see we're a hair above it, and we've also taken out the downtrend line. So that is 100% bullish unless it fails. Let me repeat that. That is bullish. So even though we have a beautiful wedge, we have negative divergence. That's a bearish setup. We now need the sell signal of a break below. There's a couple things that we can get. So, and if you scaled in here, we're just a hair above it. There's no reason, in my opinion, to stop out yet. In fact, I'm going to make a case. I'm going to get to some other things in a second. But Speaking from a purely objective point of view, at this point, being that you've broken out, although we're not far enough to have initiate a stop out yet for anyone that's scaled in here or here or here or here or took a hard entry, the best thing to do on a breakout, if you think it's going to fail, is just wait for that failure because it's not much below. So here's what we need to see. We need to see a fall back, a drop back down below this primary downtrend line and a break below the uptrend line, which is the bearish wedge. They're going to come around the same time. That will be quite bearish, a very good, powerful sell signal, in my opinion, because it will not only be a breakdown of a bearish rising wedge with negative divergence and overbought conditions, put a high probability that'll happen, but it's also going to be, if it happens, a false breakout, failed breakout. This, I promise you right now, I make very few promises in trading and investing because there are not a lot of guarantees, but I promise you I'm not the only person that sees this downtrend line off the semiconductor stocks, right? It's so apparent that a blind man can see it. So there it is. There's a breakout. If it fails, that's very bearish because it's called a bull trap. Those that bought the breakout think, oh, semis have broken out. They're going to just rip to new highs now or zigzag their way to new highs, either one. Then their stops are going to be here. They're going to recognize they're wrong. So again, it's my targets, my long-term targets are way down, well over 50% for my max target. So why not just give it that extra? It only has to drop 5% to trigger a breakdown of the, again, the bearish rising wedge pattern. Okay, sorry, I had an interruption there. I had to take a phone call. I believe I was right here on the wedge pattern. And so there it is. You have the uptrend line, and just like the stock market too, you have the 200-day moving average. It's just below as well. So right now, again, as of today, this breakout is 100% bullish above the 200s. Above, we had, well, this was a key resistance zone. That was a scaling zone. So again, to move back down below here will be a little more bearish than a normal breakdown, only because of the recent bullish developments, if that again makes sense, because it sucks in a new set of new money. Buyers that didn't want to buy back here, and when we were covering and all shorts going long, they wanted to buy here on the breakout, and so therefore they're immediately going to be underwater. If you bought back here, sure, you can ride out a pullback here. You're just giving back some of your profits. You can recycle back in there. So that's what I'll be watching for. And now in that, as I say, I always have, when I load a sector or a ETF, to the right here, I have the watch list with the top components. So both the biggest ones. These are your biggest semis right here. NVDA at 3.4 trillion and Broadcom at 1.2 trillion. So NVIDIA is ginormous, 3 times the size of the next largest semi, and then Taiwan semi just below that. So let me just cover those two since they're both actually current trade ideas. And the point being, again, as I just showed you, NVIDIA is nearly three times larger than the next biggest semiconductors out there. So obviously where NVIDIA goes, this sector goes. And keep in mind too that gives you a little bit of a false guise of strength, just like the NASDAQ 100, when just a handful of stocks, those aka Mag 7, Mag 8, whatever we want to call them, they will often give you a false guise of strength, especially when you're tracking the equal weighted indexes. You can kind of really see when that's happening. All right, so with that being said, NVIDIA, highlighted this for you. Last swing short entry we had right here. We had a sell signal there on that bearish engulfing candle that proved to be the top, and still to this day, the end of the run for the by far most popular stock out there, the biggest one. I think they overtook Microsoft recently to become the world's largest publicly traded company, 3.4 trillion, and that was still the top right there. So it shows you the other ones have kind of lost ground. Of course, Apple, everything else. Either way, sell signal there. Then last very objective short entry was highlighted on this backfill of the deep seek gap right here. That's the gap from here to here. And we got all that, which was about 40% drop. And most recently, highlighted as a short entry there again. And that's where we are as I speak right now. We hit that level, we pulled back, we hit the uptrend line, which again, I said that would be your next sell signal. We still need to take this out. So this is what I'm seeing here. The technicals are playing out very well. They're coming in, they're buying the trend line, they're buying the trend line. We haven't broke it yet. That's why we're still back to where it hit right here over a week ago. And that's it. So we could go a little bit higher. So again, your stop wouldn't be right above 129.50, 142.50. You could wedge a little higher, just like the markets, or not. All I can tell you definitively, we're at resistance, and we've been walking up this trend line. Again, when we hit it right here, I had that trend line there. Now we've had one, two, in just about every single day. We were a little bit above it 2 of those days. Every single day we've been testing and riding this trend line. So now my point is it's more significant than it was when I added it back here, because we only had a few reactions there. Now we have even more reactions. In other words, it's more obvious to the masses. More traders see this. Therefore, you're more likely to get additional short sellers jumping in there and or longs with their stop losses set there. And also, if we do break it soon, it's going to be a rejection again at a key resistance level. The last time NVDA rallied here, we know that statistically, just about all stocks, especially ones like this, the vast majority of holders are long side traders. So those longs, will remember that, especially longer term investors. They rode this out. The sky was falling. Now they've gotten back to where they were back there. And so I think if we can get that sell signal there, it will, I can tell you, will certainly help the odds that SOXX wedge will break down. And then the other one is Broadcom. Broadcom I gave you on Friday with a sell signal to come on any break below 247.88, which we got shortly after that. So it was a sell signal and a short active. Remember, it was posted as a short setup, and now it's a active, or as a Friday, an active short trade. And so far, so good. We broke first the uptrend line. Then we broke that horizontal support right there, 247.88, and we're below it. So far, so good. Now, a ton of work to be done. Again, this thing is way above the 200-day moving averages, but if it gets down to my fourth target, it will have taken those out. And you have some pretty aggressive longer-term targets. Again, your stop will be commensurate with your price target or targets. I just wanted to point out these are the two biggest. So on this one, we do have a sell signal, NVIDIA. Not yet on the break of the trend line. Remember, a rally into resistance is not a sell signal per se. It is an objective short entry. A sell signal, of course, like a trend line break, is also an objective short entry. So that's two ways to objectively enter stock, just like a long. Long stocks, you either buy on a pullback to support, that's objective, or you buy a breakout of a bullish chart pattern, something like a bullish falling wedge when it breaks out. Alrighty, next up, Treasury bonds. So we'll start with TYX. TYX is the 30-year Treasury bond yield. And as I've been stating, we are within literally one bad day in bonds, meaning a rise in yields. And bonds go up. Remember, yields go up and bond prices fall. So as I showed you last week, you can measure when I say one bad day, meaning a big move. A typical move in Treasuries is in the long bond 1% or less in a typical day. But in a bad day, they'll go up or down more than 1%, and we could do that. So now, or not. That's the thing. As I often say, resistance is resistance. Told them let's take it out. That's the multi-year highs right there. We tested it back here. That was a high from 2023. We tested it there. We fell back. We also had negative divergence. We also had an uptrend line, which was since broken. So by just about all metrics on this time frame, it looks like again, yields have broken down, and I had a resistance level right here. It was resistance. We broke it, and then we failed, we went back below it. So by just about every metric, it looks like yields are going to go down, and they might. And again, what I'm laying out here are things to watch. But if they don't, we pop back above there and we break the recent highs, it's going to be a breakout to new multi-year, and even as I've covered before, you go to a weekly chart, multi-decade highs. As I grab right here, let's just say we go up to this point. That'd be about a 5.6 5.66% yield on the 30-year. If I take a horizontal line, as I showed you, we go back to where rates were all the way back in the late 90s, early 2000s, and we'll be above where we were even when the financial crisis hit. This recent test right here of these multi-year highs, take that horizontal line, this is where the bear market started in the financial crisis, and that yields dropped because of the flight to safety bid. So again, we haven't broken out to new highs. We could very well get rejected. There's big negative divergences that say there's a decent chance that may happen. But all I'm saying, we are just a bad day or two away. That doesn't mean tomorrow, doesn't mean next day. It just means if we had a bad day this week, we could break out to new highs, and the market would quickly get the memo, I believe, if we do this. And so keep an eye on that. That's where we're at. IEF is the 10-year Treasury. Here's TLT. TLT is the 10-year bond ETF, or 30-year bond ETF. There's your support right there, about 82.50. Basically, if you're tracking TLT, it's the recent lows. You can look at the 60-minute chart right here. Where we go? Okay. So I told you we recently put in this divergent low, which was a catalyst for rally. We got one so far. Breakout. We're zigzagging up. So by most technical metrics, this is bullish right here. We just put in the divergent low, strong positive divergence. It's where we usually go long on Treasury bonds. Broke out. It's zigzagging higher. It's in a near-term uptrend. 1, 2, 3 so far higher lows, and 1, 2, 3 higher highs. That is an uptrend. However, see this blue line right here? If we take that out, that's going to start to call that uptrend into question. It's also price support. That was a major reaction low back in January, another major reaction and divergent low. I believe we were long at both those, pointing those out for trades. And then we dipped below it. There was a breakdown, and we recovered back above it. So that's bullish. So this to me is a big level, and we're very close. So watch that level. It's about 84, 87. And then if that goes, obviously the recent lows, and then that's it. That's where the stock market should really start to take note. And speaking of that, when you look at IEF, that's the ETF that tracks the 10-year Treasury bond. And going way back when, if you follow me for this long, going back into early 2024, started to give you 4 zones. A green zone right here, which is net bullish for the stock market. A yellow zone where the stock market would start to take note of rising yields. An orange zone, which says the stock market really starts to take note of rising yields. And then the red zone, which we have yet to hit, and that's where the stock market will freak out. So we've come down close a couple times, not by mere coincidence. We hit that. Remember what happened, right? In the beginning of the year, we just came off. When you flip over to QQQ, look at early January. Again, not mere coincidence. We got down there, deep into my orange zone in the beginning of the year. The stock market, that was pretty much at its highs, made a marginal new high, right? So was looking for sell signals there. We got one, pushed up, made a marginal new, ever so slightly higher high, and then the biggest drop in years. Very, very profitable to trade on the short side, or very profitable to close out your longs if you don't like shorting, sidestep it, and then buy back in at much lower levels. So flipping back to IEF, you've got the orange zone here. I'm drawing the line. This is what delineates the yellow and orange zone. Just a week or so ago, we dipped into it briefly. I highlighted that at time, and not by mere coincidence, that's when we hit that first target on that short-term swing trade for QQQ. We hit the target there. What happened? Yields, the bonds bounced, meaning yields started going back down. So the stock market had a little relief rally and bounce, as expected, off the first target. Again, that was, you can see here, right around that time. That was Wednesday, the May 21st. QQQ hit it in pre-market. Remember, it was a full tag of T1 right here in pre-market. So you're not seeing it here, and that was on right around that time, the 23rd. So Treasury rates went up first, then equities started falling. Had they continued higher, I could all but guarantee you we would have gone down to T2 before we bounced. But what happened is they bounced. Yields started going down a little bit, so this market had this another hurrah right there. So that's it. So on that, again, This has worked very, very well now for the last couple years, these zones. And again, it's an incremental thing. Remember that. The deeper you get into there, the more likely it is it's going to put pressure on the market. So the biggest corrections that we've had in years were when yields got way down into my orange zone here. That was that big drop back there into the July lows. That was a catalyst for that big correction back in 2024. And this was a catalyst for the big correction that we had so far this year. And now that's where we're at. So we're a little bit above it right there. 93.40 is where I have the line. So really, to keep it simple, just watch for a break of the recent lows. And that's where it's a matter of time before the stock market will start to take note. And again, the deeper you get in the orange zone, the more pressure it puts because yields are rising. And that's it. So you can see on the 10-year, we got down to this level right here in my orange zone. So I could really, I'll tell you what, I could probably take the red zone up to that level now that we have two distinct reactions right there, because that will be very technically significant. If I'm going to put at least a line there, and I'll probably change it later. There you go. So let's make that a red line. That'll remind me. About 91 is the price level on IEF. Okay, last but not least, remember there is a bubble, at least by my opinion, maybe the real deal, but again, it has, if it looks like a duck, walks like a duck, quacks like a duck, and AI in tech. So, and it's also a vicious cycle, if you will, or a positive feedback loop with Apple or Amazon, all of them, Apple, Amazon, Meta, Alphabet, plowing money into the AI trade, and then that brings up NVDA primarily, and so it keeps that going. As long as they're spending, they're huge cash cows. They have a lot of money to deploy, and they have been. God knows they've been plowing money in there. But when that goes the other way, when they start to, for whatever reason, whether they're not seeing the return on investment, whether they're saturated at that point in time, they have enough servers built, they think, for their AI for the time being, they want to cut back on CapEx spending, they cut down. And I think very few out there see how much a stock like NVIDIA has to fall. And again, you can see at my longer term targets. Now, with that being said, tech is not everything. Tech is something, but I've been watching a lot of consumer metrics, such as delinquencies on loans, new credit issuance, all these other things. Because I keep hearing the pundits on TV talk about the conflict between the hard and soft data. They say the hard data is still strong, soft data, which are like sentiment surveys and other things. I do get it. People are overly bearish right now, and has been the fuel for this rally, that people have been staying on the sidelines. You're seeing more and more money coming in, more and more short covering. I do get that argument. The bigger question is, or the bigger issue here is, if the economy turns, it doesn't matter how many shorts that you have covering. You could see this market pop to new highs, but to best of my knowledge, there's never been a recession in history without a bear market, real recession. So we'll see if this is different this time, but those are famous last words, right? All right, so this is XLF. I'm just playing around with I don't know what brought me here on a 2-hour chart. Haven't been trading this time frame, but you can see there's a downtrend line off the highs. This also right here was a divergent high. Again, I'm just marking up this. I was on a 2-hour chart for IEF, and there it is. This is the time frame I usually trade off of. The 60-minute chart, there's your downtrend line. The daily chart right there. I've covered this quite a bit recently. This is the primary uptrend line. This was a divergent high. So far, the high in the financials. Again, next to technology, forget about weightings, whether healthcare is number 2. I believe financials still are the second. Yeah, they are the second largest. And again, I can't overemphasize the importance of the U.S. economy. If the banks aren't doing well, there's a problem in the credit markets that will ultimately spill over and kill a tech bubble or a tech rally. And so from a technical perspective, we put in a divergent high. We broke down, back tested, had a drop down to a nice support level, and we bounced. I will give it points, if you will, for taking back the 200s. And again, that's why, it's certainly not an all-in moment. We could go up here. If we do make a full back test of the trend line, you're still going to extend the divergence if it happens anytime soon, or you may fall shy. Either way, this is a sector to watch. And we just broke right here. I gave you several key stocks to watch recently. two of the, JP Morgan obviously is the biggest, most important bank. They broke down, JP Morgan breakdown of the primary trend line, back test one, back test two, and it's still below the highs right there. But the two I gave you recently, or the one I gave you today, but of course I watch. I had price alerts this morning on both Visa and MasterCard. I gave you these uptrend lines, divergent highs, bearish rising wedges, or at least, uptrend line, wedge patterns. And there's your divergence. Bigger divergence really comes from all the way back here. And this is the one I threw out to you today. So this one isn't just a financial. This is kind of a tell on the economy and the consumer. So if this plays out, all I can tell you, again, take it, don't take it. It's an objective short entry. There was the first uptrend line and a divergent high. You had a sell signal there. You had a little kickback rally. Sometimes when you break down, you always bounce at least at one point. Sometimes you break down, you never exceed or go back to that previous high. Sometimes you do make a marginal new high. All I can tell you, it's a pretty well-defined trend line. Similar to what I just showed you on NVDA, right? That we had a couple points back there, and then boom, breakdown today. And again, I gave you a fairly tight stop and what I think are not very aggressive targets, very likely targets. It would take us back to the 200s again. But again, if we come back, if Visa pulls back to the 200s, you're going to see most likely the financials come back in and the stock market come back in, especially the S&P 500, which has financials in it. The NASDAQ 100 has very little, if any. NASDAQ 100 is mostly tech and biotech type stocks. So that's pretty much it. I'd watch right now. That's the point of this video. The key things to be watching, obviously the indexes themselves, levels I've covered, but at this point in time, treasuries and financials for kind of some cracks that may start things going before tech finally rolls over. And remember, if you are bullish, these same levels here can be used if you're looking, let's say you're bullish and you like the financials, you just don't want to chase them right here. You think they're a little higher. Well, T1 is support. It's the first support level where reaction's likely. That would be your buy point if you're looking objective levels to buy into. Likewise, Broadcom, which we just shorted, AVGO, or NVDA. NVIDIA is at trendline support now. I wouldn't buy it with your money at trendline support with negative divergences and also at the deep gap. However, that's an objective level to buy. Broadcom, you could have, on Friday, I wouldn't have put it as a short if I didn't think it would go down. But you were at that support. It was a breakout right here and back test of the previous highs, which has now failed. But you had also just broken the uptrend line, the primary uptrend line there. So, but with that being said, if you're bullish, you have this longer term uptrend line that comes into here, right here. We broke down there, regained it, but it's still very valid. Look how well defined this trend line is. It's something I shared. So what I'm getting at are levels that if you believe this market has a lot more room to go, these are objective levels, and who knows, maybe I'll be covering right there at T1, not just covering or reversing for a bounce, but maybe looking for new highs, depending on what happens between now and then, if we get there. If we do get there, T1 is going to be a drop of about 9.5%. It's also going to come in line with that trend line. And then obviously you can measure out the deeper targets are much, much lower. And it should go without saying, but I'll say it. We're not going to get to T7 if we don't take out the 200s. But if we take out the 200s, take out T4, T4 was a big, big level. This is a level where I would say the odds shoot up to, high 80s, maybe 90% chance that we're going to go all the way down to T7 if T4 is taken out, because T4 was excellent price support. These were multi-year highs. That was a big, giant breakaway gap to new all-time highs. We back tested it there. Then it failed, but we regained it again. So I still think it's an important level. The 200s will have just been taken out. That uptrend line will be taken out. And if so, again, if you have your eye on the prize, that would be a drop of about 51% if hit down to T7. All right, let me wrap it up here. First things first, again, so you have a lot of levels developments to watch for. Some I started out on the monthly chart. Can't really be overly concerned right now with those levels. When we get down, last, final week of this month, I'll revisit it. Weekly charts, obviously, today's Monday, so we got to wait till Friday to see if we get any, if any of those currently bearish indicators flip to bullish, or vice versa, if some of the ones that are currently bullish flip over to bearish. I'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.